Hey everyone, welcome back to Corporate Decoder. FXink's just filed an amendment to a previous 8K report, and I am seeing a slight adjustment that hints at how they value their deals. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing is an update on shares issued during an acquisition, and it shows us how they are calculating merger costs. Alright, so what we have here is an amendment to a previous report, officially called a Form 8K/A. Think of it like a correction or an update to something that was already filed. For Innovex International Incorporated, ticker symbol INVX, this filing is mainly about updating the number of shares they handed out when they bought another company, TCO Group, as a Norwegian company. So Innovex International Incorporated, which trades as INVX, is filing this to fix or add to a report from the 15th of June 2026. The main reason is to correct the number of shares that were given out as part of a deal to buy TCO Group. This is important because it affects how they account for the cost of that acquisition. Now, let's get to the numbers. On the 1st of July 2026, Innovex completed the purchase of TCO Group, and as part of the deal, they issued 1060713 shares of their common stock to the seller. This is the actual merger consideration, the value they paid to acquire the company. Here is the interesting part: the value of these shares wasn't just plucked out of thin air. The number of shares was calculated based on the average stock price over a specific period of trading days leading up to the 15th of June, 2026. They looked at the average trading price on the New York Stock Exchange for the 15 days before that date. This is a common way to determine merger consideration to ensure fairness and reduce the potential for one side to be disadvantaged by short-term market fluctuations. It spreads the pricing over a window of time. Let's remember that Innovex International Incorporated is a publicly traded company on the New York Stock Exchange under the ticker INVX, their common stock, which has a par value of 1 cent per S-hair, is what was used in this deal. Seeing their shares traded on the NYSE means they are a relatively significant company, not a small, obscure one. As of recent data, they have a market cap of around $1.7 billion with a PE ratio of about 32.4, and their stock price is hovering around $24.28. They employ over 2,000 people, so this isn't a small operation. The shares that were issued as part of this deal are their regular common stock. This means that when they issued these new shares, they were essentially diluting or spreading out the ownership of existing shareholders. For every share you owned before the deal, there are now a few more shares out there representing ownership. The par value is a very small nominal amount, essentially a legal placeholder, and the real value is in the market price. This part is about selling company stock that wasn't officially registered with the regulatory bodies. When a company issues stock as part of an acquisition, it often falls under specific exemptions like Section 4, A2 of the Securities Act of 1933. This exemption is generally for transactions not involving a public offering. They are saying that these shares were sold directly to the seller of TCO Group, not to the general public through an open market sale. This is the legal justification for why they did not have to go through the expensive and time-consuming process of registering these shares with the Securities and Exchange Commission. Section 4. A2 is a common exemption for private placements, meaning sales to a small number of sophisticated investors, or in this case, the seller of another business. It implies that the recipient of these shares, the seller of TCO Group, is assumed to be knowledgeable enough to assess the risks involved without the full protections of a public offering. So Innovex International Incorporated is essentially saying, we sold these shares directly to one party as part of a business deal, and that practice is allowed without needing to register the shares with the SEC. And finally, the filing is signed off by Adam Anderson, the Chief Executive Officer of Innovex International Incorporated, on the 1st of July 2026. This is the official stamp of approval from the company's top executive, confirming the accuracy of the information provided in this amended report. So, what does this all mean beyond the legal jargon for Innovex? This filing is a factual update about a completed acquisition. It shows they're actively engaged in growth strategies, likely buying smaller companies like TCO Group to expand their operations or market reach in the energy and oilfield services sector. The specific pricing mechanism used for the shares emphasizes their attempt to lock in a fair value based on recent market performance, which is good for stability. However, any issuance of new shares, even in an acquisition scenario, does mean a slight dilution for existing shareholders. For those invested in INVX, this is a signal that the company is growing, perhaps through adding new assets or expanding its service lines, funded partially by stock rather than just cash. The key takeaway is the precise valuation method for the deal. Now, looking at the broader context, Innovex International Incorporated has been in the news lately. Analysts at Jefferies initiated coverage on the stock in early July, which often brings attention. TradingView has been discussing their forward price to earnings ratios. There was also news about them being added to the Russell 2000 Growth Defensive Index around late June, which can lead to increased investor interest as index funds may buy their stock. All of this indicates a company that is on the radar of investors and analysts. When we look at their market position, with a $1.7 billion market cap and its inclusion in growth indexes, Innovex appears to be a growing player in the energy equipment and services industry. Their PE ratio of 32.4 suggests investors have relatively high expectations for future earnings growth, which is typical for companies in this sector that are perceived to have strong future potential. The risk I am watching is how swiftly these acquired assets translate into profitable growth for Innovex International, Incorporated, and whether the share dilution will be offset by significant revenue increases. What I am actually looking for is consistent profitability following these strategic acquisitions. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Check out the Discord in the description.